All right. Uh, let's uh, let's keep going on book club, shall we? Starting on page 41 of Peter Lynch's One Up on Wall Street, and continuing forward, we're at subsection Gating the Gigahertz. Among amateur investors, for some reason, it's not considered sophisticated practice to equate driving around town and eating donuts with the initial phase of investigation into equities. People seem more comfortable investing in something about which they are entirely ignorant. There seems to be an unwritten rule on Wall Street. If you don't understand it, then put your life savings into it. Shun the enterprise around the corner, which can at least be observed, and seek out the one that manufactures an incomprehensible product. I heard about one such opportunity just the other day. According to a report somebody left on my desk, this was a fantastic chance to invest in a company that makes a 1 megabit SRAM CMOS complete complementary metal oxide semiconductor, bipolar risk, reduced instructive set computer, floating port, data I/O array processor, optimizing compiler, 16 bits dual port memory, Unix operating system, Whetstone Megaflop, polysilicon emitter, high bandwidth, 6 gigahertz, double metallization communication protocol, asynchronous backwards compatibility, peripheral bus architecture, four-way interleaved memory, and within 15 nanoseconds of capability. Gig my gigahertz and Whetstone my megaflop. It, if you couldn't tell if it was a racehorse or a memory chip, you should just stay away from it. Even though your broker will be calling to recommend it as the opportunity of the decade to make countless nano bucks. If you haven't seen it, the 1994 press on C-SPAN where he read that himself was very funny. A pox on the Cabbage Patch. Does that mean I think you ought to buy shares in every new fast food franchise, every business that has a hot product, or every public company that opens an outlet in the local mall? If it were that simple, I wouldn't have lost money on Bildner's, the yuppie 7-Eleven right across the street from my office. If only I'd stuck to the sandwiches and not to the stock. 50 shares of which would scarcely buy you a tuna on rye. More on this later. And how about Coleco? Just because the Cabbage Patch doll was the best-selling toy of this century, it couldn't save a mediocre company with a bad balance sheet. And although the stock rose dramatically for a year or so, spurred on by the first home video games and then by the Cabbage Patch enthusiasm, eventually it dropped from a high of $65 in 1983 to a recent 1 3/4 as the company went to Chapter 11, filing for bankruptcy in 1988. Finding the promising company is only the first step. The next step is doing the research. The research is what helps you sort out Toys R Us from Coleco. That just didn't age so well, did it? Apple Computer from Televo. That one did. Or Pedimont Airlines from People Express. Now that I mention it, I wish I had done more checking into what was happening at People Express. Maybe then I wouldn't have bought that one either. All my failures notwithstanding during the 12 years, I've managed Fidelity Magellan. It has risen over 20-fold per share, partly thanks to some of the little-known and out-of-favor stocks I've been able to discover and then research on my own. I'm confident that any investor can benefit from these same tactics. It doesn't take much to outsmart the smart money, which, as I've said, isn't always very smart. This book is divided into subsections. The first, Preparing to Invest, chapters 1 through 5, deals with how to assess yourself as a stock picker, how to size up the competition, portfolio managers, institutional investors, and other Wall Street experts, how to evaluate whether stocks are riskier than bonds, how to examine your financial needs, and how to develop a successful stock picking routine. The second, Picking Winners, chapters 6 through 15, deals on how to find the most promising opportunities, what to look for in a company, and what to avoid, how to use brokers, annual reports, and other resources to best advantage, and what to make of the various numbers, PEs, book value, cash flow. that are often mentioned in technical evaluations of stocks. The third, the long-term view, chapters 16 through 20, deals with how to design a portfolio and how to keep tabs on these companies in which you've taken interest, when to buy and when to sell, the follies of options and futures, and some general observations about the health of Wall Street. American enterprise and the stock market, things I've noticed in 20 odd years of investing. Part 1, preparing to invest. Before you think about buying stocks, you ought to have made some basic decisions about the market, about how much you trust corporate America, about whether you need to invest in stocks and what you expect to get out of them, about whether you are short or long term, and about how you will react to sudden, unexpected, and severe drops in price. It is best to define your objectives and clarify your attitudes. Do you really think stocks are riskier than bonds? Beforehand, because if you are undecided and lack conviction, then you are a potential market victim who abandons all hope and reason at the worst moment and sells out at a loss. It is personal preparation, as much as knowledge and research, that distinguishes the successful stock picker from the chronic loser. Ultimately, it is not the stock market or even the companies themselves that determine an investor's fate. It is the investor. The making of a stock picker. There is no such thing as a hereditary knack for picking stocks. Though many would like to blame their losses on some inbred, tragic flaw, believing somehow that others are just born to invest, and my own history refutes it. There was no ticker tape above my cradle, nor did I teethe on stock pages in the precocious way that a baby Pele supposedly bounced a soccer ball. As far as I know, my father never left the pacing area to check on the price of General Motors, nor did my mother ask about the ATT dividend between contractions. Only in hindsight, I can report that the Dow Jones Industrial Average was down on January 19th, 1944, the day I was born, and declined further the week I was in the hospital. Though I couldn't have suspected it then, this was the earliest example of the Lynch law at work. The Lynch law, closely related to the Pareto principle, states, whenever Lynch advances, the market declines. The latest proof came in the summer of 1987, when just after the publisher and I reached an agreement to produce this book, a high point in my career, the market lost 1,000 points in 2 months. I'll think twice before attempting to sell the movie rights. Most of my relatives distrusted the stock market, and with good reason. My mother was the youngest of 7 children, which meant that my aunts and uncles were old enough to have reached adulthood during the Great Depression, and to have a first-hand knowledge of the crash of '29. Nobody was recommending stocks around our household. The only stock purchase I ever heard about at the time was the time my grandfather, Gene Griffin, bought City Service. He was a very conservative investor, and he chose City Service because it was a water utility. When he took a trip to New York and discovered it was an oil company, he sold immediately. City Service went up 50-fold after that. Distrust of stocks was the prevailing American attitude throughout the 1950s and into the 1960s, when the market tripled and then doubled again. This period of my childhood, and not the recent 1980s, was truly the greatest bull run market in history. But to hear it from my uncles, you'd have thought it was the craps game behind the pool hall. Never get involved in the market, people warned. It's too risky, and you'll lose all your money. Looking back on it, I realized there was less risk of losing all of one's money in the stock market. Looking back on it, I realized there was less risk of losing all one's money in the stock market of the 1950s than at any time before or since. This taught me not only that it's difficult to predict markets, but also that small investors tend to be pessimistic and optimistic at precisely the wrong times. It's so self-defeating to try to invest in good markets and get out in bad ones. My father, an industrious man and former mathematics professor who left academia to become the youngest senior auditor at John Hancock, got signed when I was 7 and died of brain cancer when I was 10. This tragedy resulted in my mother's having to go to work at Ludlow Manufacturing, later acquired by Tyco Labs, and I decided to help out by getting a part-time job myself. At the age of 11, I was hired as a caddy. That was on July 7th, 1955, the day the Dow Jones fell from 467 to 460. To an 11-year-old who had already discovered golf, caddying was the ideal occupation. They paid me for walking around a golf course. In one afternoon, I would out-earn delivery boys who tossed newspapers onto lawns at 6 a.m. for 7 days in a row. What could be better than that? In high school, I began to understand the subtler and more important advantages of caddying, especially at an exclusive country club such as Bray Burn, outside of Boston. My clients were the presidents and CEOs of major corporations, Gillette, Polaroid, and more to the point, Fidelity. In helping D. George Sullivan find his ball, I was helping myself find a career. I'm not the only caddy who learned that the quickest route to the boardroom was through the locker room of a club like Bray Burn. If you wanted an education in stocks, the golf course was the exact place that was the best thing to being was the next best thing to being on the floor of a major stock exchange. Especially after they'd sliced or hooked on a drive, club members enthusiastically described their latest triumph investment. In a single round of play, I might give out 5 golf tips and get back 5 stock tips in return. Though I had no funds to invest in stock tips, the happy stories I heard on the fairways made me rethink the family's position that the stock market was a place to lose money. Many of my clients actually seemed to have made money in the stock market, and some of the positive evidence actually trickled down to me. A caddy quickly learns to sort his golfers into a caste system, beginning with the rare demigods. Great golfer, great person, great tipper. Moving down through the so-so golfers and the so-so tippers, and eventually hitting bottom with a terrible golfer, terrible person, terrible tipper. A dreaded untouchable of the links. Mostly I caddied for average golfers and average spenders, but if it came down to a choice between a bad round with a big tipper or a great round with a bad tipper, I learned to opt for the former. Caddying reinforced the notion that it helps to have money. I continued to caddy throughout high school and into Boston College, where the Francis Oyment Caddy Scholarship helped pay the bills. In college, except for the obligatory courses, I avoided science, math, and accounting, all the normal preparations for business. I was on the art side of the school, and along with the usual history, psychology, and political science, I also studied metaphysics, epistemology, logic, religion, and the philosophy of the ancient Greeks. As I look back on it now, it's obvious that studying history and philosophy was a much better preparation for the stock market than, say, studying statistics. Investing in stocks is an art, not a science, and people who have been trained to rigidly quantify everything have a big disadvantage. If stock picking could be quantified, you could rent time on the nearest Cray computer and make a fortune. But it doesn't work that way. All the math you need in the stock market, Chrysler's got $1 billion in cash, $500 million in long-term debt, etc., you can get in the 4th grade. Logic is the subject that's helped me the most in picking stocks, if only because it taught me to identify the peculiar illogic of Wall Street. Actually, Wall Street thinks just as the Greeks did. The early Greeks used to sit around for days and debate on how many teeth a horse has. They thought they could figure it out just by sitting there, instead of checking the horse. A lot of investors sit around and debate whether a stock is going up, as if the financial muse will give them the answer, instead of checking the company. In centuries past, people hearing the rooster crow as the sun came up decided that the crowing caused the sunrise. It sounds silly now, but every day the experts confuse cause and effect on Wall Street in offering some new explanation for why the market goes up. Hemlines are up, a certain conference wins the Super Bowl, the Japanese are unhappy, a trend line has been broken, Republicans will win the election, stocks are oversold, etc. When I hear theories like these, I always remember the rooster. In 1963, my sophomore year in college, I bought my first stock, Flying Tiger Airlines, for $7 a share. Between the caddying and the scholarship, I'd covered my tuition. Living at home reduced my other expenses, and I had already upgraded myself from an $85 car to a $150 car. After all the tips that I had to ignore, I was finally rich enough to invest. Flying Tiger was no wild guess. I picked it on the basis of some dogged research into a family premise. One of my first classes, I'd read an article on the promising future of air freight, and it said that Flying Tiger was an air freight company. That's why I bought the stock, but that's not why the stock went up. It went up because we got into the Vietnam War, and Flying Tiger made a fortune shunting troops and cargo in and out of the Pacific. In less than 2 years, Flying Tiger hit 32 and three quarters, and I had my first five bagger. Little by little, I sold it off to pay for graduate school, and I went to Wharton in, on a partial Flying Tiger scholarship. If your first stock is as important to your future in finance as your first love is to your future in romance, then the Flying Tiger pick was a very lucky thing. It proved to me that that the big baggers existed, and I was sure there were more of them from where this one had come. During my senior year at Boston College, I applied for a summer job at Fidelity at the suggestion of Mr. Sullivan, the president, the hapless golfer, great guy, and good tipper for whom I'd caddied. Fidelity was the New York Yacht Club, the Angostura National, the Carnegie Hall, and the Kentucky Derby. It was the Clooney of investment houses and the, like the great medieval abbey to which monks were flattered to be called, what devotee of balance sheets didn't dream of working there? There were 100 applications for 3 summer positions. Fidelity had done such a great job selling America on mutual funds that even my mother was putting $100 a month into Fidelity Capital. That fund, run by Jerry Sy, was one of the 2 famous go-go funds of this famous go-go era. The other was Fidelity Trend, run by Edward C. Johnson III, also known as Ned. Ned Johnson was the son of fabled Edward C. Johnson II, also known as Mr. Johnson, who founded the company. Ned Johnson's Fidelity Trend and Gary Sy's Fidelity Capital outperformed the competition by a big margin and were the envy of the industry over the period from 1958 to 1965. With these sorts of people training and supporting me, I felt as if I understood what Isaac Newton was talking about when he said, "If I have seen further, it is by standing upon the shoulders of giants." Long before Ned's great success, his father, Mr. Johnson, had changed America's mind about investing in stocks. Mr. Johnson believed that you could invest in stocks, not to preserve capital, but to make money. Then you take your profits and invest in more stocks and make even more money. Stocks you trade, it's wives you're stuck with, said the always quotable Mr. Johnson. He wouldn't have won any awards from Mrs. Magazine. I was thrilled to be hired at Fidelity and also to be installed in Gary Sy's old office after Sy had departed from the Manhattan Fund in New York. Of course, the Dow Jones Industrials, in 1925 when I reported for work on the first week of May, 1966, had fallen below 800 points by the time I headed off to graduate school in September, just as the Lynch Law would have predicted. Subsection Random Walk and Maine Sugar. Summer interns such as me, with no experience in corporate finance or accounting, were put to work researching companies and writing reports the same as the regular analysts. The whole intimidating business was suddenly demystified. Even liberal arts majors could analyze a stock. I was assigned to the paper and publishing industry and set out across America to visit companies such as Sword Paper and International Textbook. Since the airlines were on strike, I traveled by bus. By the end of the summer, the company I knew most was about Greyhound. After that interlude with Fidelity, I returned to Wharton for my second year of graduate school, more skeptical than ever about the value of an academic stock market theory. It seemed to me that most of what I had learned at Wharton, which was supposed to help you succeed in the investment business, could only help if you fail. I studied statistics, advanced calculus, quantitative analysis. Quantitative analysis taught me that the things I saw happening at Fidelity couldn't really be happening. I also found it difficult to integrate the effective market hypothesis that everything in the stock market is known and the prices are always rational, with a random walk hypothesis that the ups and downs of the market are irrational and entirely unpredictable. Already I'd seen enough odd fluctuations to doubt the rational part, and the success of the great Fidelity fund managers was hardly unpredictable. It also was obvious that Wharton professors who believed in quantum analysis and random walk weren't actually doing nearly as much as my new colleagues at Fidelity. So between theory and practice, I cast my lot with the practitioners. It's very hard to support the popular academic theory that the market is irrational when you know somebody who just made 20-fold profit in Kentucky Fried Chicken, and furthermore, who explained in advance why the stock was going to rise. My distrust of theorizers and prognosticators continues into the present day. Some Wharton courses were rewarding, but even if they'd all been worthless, the experience would have been worth it, because I met Carolyn on the campus. We got married while I was in the Army on May 11th, 1968, a Saturday when the market was closed, and we had a week-long honeymoon during which the Dow Jones lost 13.93 points. Not that I was paying attention. This is something I looked up later. After finishing that second year at Wharton, I reported to the Army to serve my 2-year hitch required under the ROTC program. From 1967 to 1969, I was a lieutenant in the artillery, sent first to Texas and later to Korea, a comforting assignment considering the alternative. Lieutenants in the artillery mostly wound up in Vietnam. The only drawback to Korea was that I was far away from the stock exchange, and as far as I knew, there was no stock market in Seoul. By this time, I was suffering from Wall Street withdrawal. I made up for the lost time during infrequent leaves when I'd rush home to buy the various hot stocks that friends and colleagues recommended. They were buying high-flying issues that kept going up, but for me, they suggested conservative issues that kept going down. Actually, I made some money in Ranger Oil, but I lost more in Maine Sugar and a sure-win situation that flopped. The Maine sugar people had gone around to all the Maine potato farmers to convince them to grow sugar beets in the off-season. This was going to be extremely profitable for Maine Sugar, not to mention for the Maine farmers. By planting the sugar beets, the perfect companion crop to potatoes, farmers could make extra money and revitalize the soil at the same time. Moreover, Maine Sugar was footing the bill for planting the beets. All the farmers had to do was haul the grown-up beets to the huge new refinery that Maine Sugar had just built. The hitch was that these were Maine farmers, and Maine farmers are very cautious. Instead of planting hundreds of acres of sugar beets the first year, they tried it on a quarter acre. And then when that worked, they expanded to half an acre. And by that time, they got to a full acre. The refinery was shut down for lack of business, and Maine Sugar went bankrupt. The stock fell to 6 cents, so one share could buy you 6 gumballs from a Lions Club machine. After the Maine Sugar fiasco, I vowed to never buy another stock that depended on Maine farmers chasing after a quick buck. I returned from Korea in 1969, rejoined Fidelity as a permanent employee and research analyst, and the stock market promptly plummeted. The Lynch law theorists take notice. In June of 1974, I was promoted from assistant director of research to director of research, and the Dow Jones lost 250 points in the next 3 months. In May of 1977, I took over the Fidelity Magellan Fund. The market stood at $18.99 and promptly began a 5-month slide to 801. I think I said 18, but 899. Fidelity Magellan had $20 million in assets. There were only 40 stocks in the portfolio, and Ned Johnson, Fidelity's head man, recommended that I reduce the number to 25. I listened politely and then went out and raised the number to 60 stocks. 6 months later, to 100 stocks, and soon after that, to 150 stocks. I didn't do it to be contrary. I did it because when I saw a bargain, I couldn't resist buying, and in those days, there were bargains everywhere. The open-minded Ned Johnson watched me from a distance and cheered me on. Our methods were different, but that didn't stop him from accepting mine. At least, not as long as I was getting good results. My portfolio continued to grow to the point where I once owned 150 S and L stocks alone. Instead of settling for a couple of savings and loans, I bought them across the board, after determining, of course, that each was promising investment in and of itself. It wasn't enough to invest in one convenience store. Along with Southland, the parent company at 7-Eleven, I couldn't resist buying Circle K, National Convenience, Shop and Go, Hop In Foods, Fairmont Foods, and Sunshine Junior, to mention a few. Buying hundreds of stocks certainly wasn't Ned Johnson's idea of how to run an equity fund, but I'm still here. Soon enough, I became known as the Will Rogers of equities, the man who never saw a stock you didn't like. They're always making jokes about it in Barron's. Can you name one stock that Lynch doesn't own? Since I own 1,400 at present, I suppose they have a point. Certainly, I can name plenty of stocks I wish I hadn't owned. Meanwhile, however, the assets in Fidelity Magellan have grown to $9 billion, which makes this fund as large as the gross national product of half of Greece. In terms of return on investment, Fidelity Magellan has done much better than Greece over the 11 years, although Greece has an enviable record over the preceding 2,500. As for Will Rogers, he may have given the best bit of advice ever uttered about stocks. Don't gamble. Take all your savings and buy some good stock and hold it till it goes up. Then sell it. If it don't go up, don't buy it. That's chapter 1 and the rest of the introduction. We'll pick up some other time.